right? Trading all-time highs in any market. Now, I have that slightly different in the wording because I want you to understand that while I'm talking about this tonight over a NASDAQ chart, I know some of you that are all forex only, and you're already thinking, I'm never going to talk about forex. I am going to talk about forex. Everything I'm talking about tonight is applicable to forex and futures and any other market. Okay, so when we get into the analysis, which won't start until 2 weeks from now. Okay, so I told you there'd be 10 fundamental and foundational studies and lectures. So there'll be one this Saturday. There won't be any on Saturday and Sunday normally. So this week, just because I gave you a little teaser last night and just to see who would complain, so I could block them on my social media accounts. I don't want to see complainers. The idea is that we're going to teach the principles that I want to cover. They're topical studies. Okay, so I'm not teaching a model. I've already taught enough models. I'm teaching topical studies that will help enhance the likelihood that you'll find success with what I already taught. Okay, so it's not that I'm trying to reinvent the wheel or give you something new and shiny. I'm trying to build and beef up your present understanding. Okay, so that's really primarily what we're doing over the next couple months until we get into the second week of November, and then I'll go on to my traditional holiday break. All right, so trading all-time highs in any market. When a market is trading at all-time highs, it is more likely that it will continue to post higher all-time highs. Key reference points in algorithmic price delivery. Look for price to trade under down close candles closing prices. These are rejection blocks and they tend to promote new runs higher in price. If possible, look for all buy-side imbalance, sell-side inefficiency, fair value gaps to offer redelivery prior to new legs higher in price. Grade all premium candle wicks and anticipate the gradient levels to offer discount sensitivity in price. Look through up-close candles and refer to the premium candle wicks. They need not be isolated, and I'll cover what that means in a few moments. Look for price to trade under up-close candles closing prices. Near all-time highs, markets tend to overshoot previous close redelivery in the form of bear traps. Immediate rebalance is typically very strong and is likely to offer discount sensitivity. Avoid predicting the reversal high. In other words, simply stay bullish until the market proves to you that it's completely and utterly broke down and reversed. Now that might sound scary. What happens if I get into a trade, Michael, and I'm long and the market completely collapses and hurts me and I lose money? That's part of this. You can't go through this industry and have a career where you never have anything bad happen to you. That's unfortunate because everyone comes into this industry like I did too, and we think that we're going to be the exception. We're not going to find that very painful outcome. And if you're going to be trading markets that are trading at all-time highs, you either let the market go without you and trade something else, or you submit to the idea that you want to keep taking buy signals and let money management and good trade management do its job. If you're not over leveraging, if you're not over trading, pushing the boundaries of what you're really capable of weathering as a trader in terms of a loss. As long as you're not doing that, it won't take you out of the game. If you're fearful that it's going to take you out of the game on any one particular trade or one market condition setup, then you're probably over leveraging and you're doing too much where the outcome of one single transaction will completely undermine you. And no trader should ever have their leverage or gearing on their trades that high. All right, so we're going to take a look at the chart here on the left-hand side, and this is a daily chart. So we're not going to look at anything below a daily chart. So everything here is germane to bias. It's germane to narrative, how that's going to blend together and incorporate the idea and the aspects of all-time highs. Now, this high here is the all-time high prior to the run higher that we've seen trading up to 24,403.5. So we're going to be looking at the central tenets that I've covered here on the right in a list throughout the price action shown on the daily chart. So first we see that there is a sell side liquidity pool raid here. So that run right below that low, it's taken the sell side liquidity here, and then now it's going to start to gravitate back to this high here. Now, before it gets there, we have this short-term high. So this is going to be the highest probability high it's going to trade to. But keeping with the rules, when we're trading near all-time highs, it's likely to continue to make higher highs, higher all-time highs. So we would anticipate this high being taken out should it trade to it. But working from this low here, we'll start annotating everything. So we have an up-close candle here, the closing price of that candle. Notice the next candle we open and we trade down below it. So trading below that previous day's close, if there was a opening range gap, for instance, many times when we're trading at all-time highs or near all-time highs, trading right back to the previous day's close, it can overshoot it. And the reason why it does that is because there's a lot of people in this industry that understands the gap that forms from the previous day's close and where we open at 9:30 in the morning or whatever the market opening price would be. That gap inefficiency, gaps tend to rebalance, trade back to them, offer both buy side and sell side delivery in that gap, and then price goes in the direction of the gap. But when we're trading near all-time highs, it tends to create these little bear traps where it doesn't just simply go back to the previous day's close. It goes beyond that and trades lower. What do you think the mindset is of the traders that sees that? They're going to think, wow, it's gone beyond just simply going back and closing any opening range gap. It's broke down and traded below the opening range gap and went lower. So they're going to think what? The market's going to keep going lower. And they're going to think that the market is now topped. And that's what the market makers tend to do in this general market condition. These are just very generic principles that I live by as a trader. And if you incorporate them, you're not going to be completely exempt from having anything bad happen to you. It doesn't mean you're not going to have losing trades or do it wrong. It just means that at least you won't be guessing like everyone else does. Because every other individual out there, they're all going to try to pick the top. They're all expecting a crash. They're all trying to get the next big, slide in price lower. And what I'm going to do is press on you to think about how they're going to just keep taking it higher. So this is what I mean by overshooting below the previous day's close. Right here, the next day we open, we trade down below that close, and traders that are looking for a collapse in price, they may even look at this as relative equal lows that the market may want to trade down there and take that out. Try to avoid that, okay? And the next example here is immediate rebalance. This market creates a nice big up close candle. We open here, we trade back down to the previous day's close. So what are they going to do? They're going to overshoot that. And it does. It trades all the way back down to the day before this up close candle to offer an immediate rebalance. So two principles there are happening. We're opening, trading back to the previous day's close, but not just closing that gap and then going higher. It's closing that gap and going all the way back over top and redelivery back to this candle's high. That's immediate rebalance. When that happens, generally you're going to see a very, very strong reaction. There's going to be a lot of discount sensitivity, meaning that the market's going to treat that as a very strong discount PD array, and the market's going to immediately launch higher from there. And you can see that actually happens here. And then the next day, we open below the previous day's close, which is another tenet where we open, we trade down below the previous day's close. That's a rejection block, that closing price here on a down close candle. And it's going to be rejected, as you can see here, comes right back up. But notice it doesn't take out that candle's high. The next day we open, we got a small little gap there. So what's going to happen is it's going to probe, okay? It's going to go below, just closing that gap is what everybody's expecting, but it's going to go below that previous day's close and entice traders to do what? Be short. So we have that rejection block discount sensitivity on this candle. And now we have this premium candle wick, and we're grading that. So we have the lower quadrant, consequent encroachment, upper quadrant, and we don't need the high and the low annotated. We're going to look at the chart to see what that is. But notice the sensitivity here at the 75 quadrant. We open, breach the previous day's close. So everyone that wants to see just simply the gap closure and then continue higher, they're getting toasted here. Trades down to that lower quadrant, overshoots it a little bit, and then sends it higher, taking out the previous 2 days high. Then the next day, we have a higher open. We trade down to the previous day's close. Again, that gap, it's a trap to set for bears. It drops lower down to the 50% level of that premium candle wick again. We cut through these candles. All of these premium candle wicks, keep them annotated because the market's going to go back into those levels again. When it overshoots the previous day's closing price, it's going to trap traders simply looking for the gap closure and then buying. It's going to go lower. It does this a lot. And I'm not expecting you to just simply use this because it looks like I'm cherry picking. Go back over old market data. Look at stocks. Stocks are really good with this. So if you're a trader that wants to trade, MISE stocks or NASDAQ stocks, this is a principle that repeats a lot with them as well. The gaps tend to be a little bit larger there too. So it gives you a lot of volatility if you're trying to day trade those assets. I don't like to day trade stocks, but I just toss it out there for no extra charge. But we see the premium candle wick gradient discount sensitivity here. On this candle, we open, we have a volume imbalance. We trade down to this premium candle wick, and its halfway pointer is the consequent encroachment, and notice how it trades right down to that. So not only do we open here, we go back to the previous day's closing price. Most traders that are watching this on a day trading basis, they're going to see that and think, okay, well, it's gap closure. Now it's going to rally because it's bullish, and the market just goes even lower, but goes right back to where I teach you to watch these premium candle wicks. The consequent encroachment hits it there beautifully and then trades higher. And the next day we open, come back to the previous day's close, overshoot it again to the downside, suckering in people thinking it's created a top. It has to have created a top, and they get short, and then the market runs right over top of them again, reaching the all-time high, as we indicated a little bit ago. So I want you to think about how using these principles, these very generic ideas that it's not complicated, they keep repeating, and it keeps you on your toes about anticipating some measure of manipulation. So this is what generally the retail traders get caught up in because they're chasing price, anticipating, hoping, and praying basically that the market's going to break down and collapse. But all the market does is go back to these previous PD arrays algorithmically and then delivers and spools higher. And it's very frustrating if you don't know these things. Maybe you've been hurt. Maybe you've been trying to capture the high in this market or another market. And you can go back and look at your trades and you can pretty much see that what you failed on is what I'm showing how you can avoid doing that in the future. And I'm not saying you're not going to take losing trades. I'm saying that at least you're going to know now how the market's algorithm reprices back into these very specific PD arrays when they're trading at all-time highs or near all-time highs. Until the market completely collapses and shows you it's reversed, don't look for shorts. It's better for you to anticipate it like this because you'll get the lion's portion of the move. You'll be on side. You'll be within the narrative. You'll be with the bias correctly. Higher time frame order flows in your favor, and you'll be able to weather the daily range ebb and flow up and down and get the lion's portion of the move.